friends. What do you notice about this chart? Well, we are in record territory yet again, and I'm happy to say that. The blue bars, dollar value corresponding to that right-hand side, and thanks, JC, for coordinating with the AV guy so that this thing works terrific now, and I don't have to rely on the notes on my palm of my hand. You can also see not a bad year, not as crazy, insane good in terms of year-over-year change as 2012. 2012 was really, as you know, everybody stretched those supply chains. But 2013 was pretty good with, I think, well, you can see in the next chart, about 6% year-over-year growth. We're in good times. We're the healthiest part of the world economy still. And as you can see, aside from the year-over-year growth, we had a pretty good run even during the really bad years of the economic meltdown. So this is an industry with a couple of soft spots and a couple of areas of concern that's fundamentally in great shape. I mean, this is really solid. Right now, as I mentioned, 175 billion in new deliveries. There is a world behind this that is much bigger of aftermarket sustainment and all that other stuff. So all told, we're worth the better part of 400 billion a year to the world economy. That's admirable. And now, a bunch of numbers. And cue the audio file that I did not send. Oh well. Anyway, we are back in black. Anyway, you can play the music in your head for a moment, but that's a good thing. I mean, as you can see, for a bunch of years, we had a kind of weird mix of black ink and red ink. And you can see the compound annual growth rate in that first column between 03 and 08. This is, as you know, you've seen this. Many of you who are veterans of this, you've seen this fiendishly overcomplicated chart, but I'll quickly walk you through it. The first column shows industry segment by dollar value of deliveries last year. So 94 billion in jetliner deliveries for a total industry of 169 billion. The CAGR 03 to 08, the CAGR and the change 08 to 12, when really bad things happened and we had lots of red ink. And then finally, that column for last year, everything is finally, well, back in black. I'm a little concerned about some of those numbers, and if you break down some of these things, I'll get to that later, you actually see quite a bit of softness. But in terms of macro, our traditional approach to looking at the industry at a macro level first, we're totally back in black ink, and that's certainly a very good thing. As you can see, the big driver of what kept us going during the really terrible years of 08 to 12 were our good friends, the big heavy metal jetliners. You can see that they grew 60% during the worst economic meltdown since World War II. That, of course, is one of the bigger mysteries I've ever encountered in my any of our professional careers. Let's face it, we're all still trying to digest, what the hell just happened. Because by any conventional indicator, well, that shouldn't have happened, period. Because normally, as we know, once upon a time, the jetliner industry was defined by cycles. And you had billboards in Seattle back during the bad years here that said, last 1 year, please turn out the lights. And we were used to a 1/3 off peak to trough ratio, and instead, we just went bad at hell crazy, and between 2004 and 2013, we have an aggregate compound annual growth rate of just above 10%. Wow. That shouldn't have happened. I mean, when I started doing this job, which, as JC said, originally involved turbine engines, because all the cool kids are going into turbine engines, many years ago, it was a simple way of doing things. I suspect many of you have at one point had a little exercise, compare output with GDP, which of course translates to travel demand, which translates to airline profits and yields, which translates to orders, which, all that other stuff. It's a relatively straightforward model, and I can assure you that it does not give you a 10% compound annual growth rate between 2004 and 2013, far from it. So we're in weird turf here. Here's that same chart that shows year-over-year change and the actual output, also back from 1960 to 2013. And there we are at that $94.4 billion figure. Boy, this is... I'm a little concerned, as I always am, my natural state of concern is to be concerned, I suppose. Every year, obviously, Airbus and Boeing and everybody else who does a forecast uses the base year as a jumping off point, and you keep redefining the base year upward and upward to the tune of 10% a year per decade. That's a dangerous place to be. And I think there's no way around it. Hey, I do it too. But on the other hand, be mindful here, we're kind of floating in space. If anything should have precipitated a downturn, it was this. The GDP figures for the world, which not only were negative for the first time since World War II back in 2009, but, frankly, have never been all that great in terms of a V-shaped recovery. This is not the kind of economic backdrop you want, propping up 10% year-over-year growth. It's adequate now. It's okay. You're experimenting with a top-secret plan for a triple-dip recession, but, maybe they'll get it right one day. And everybody else just doing okay. Developing Asia, a bit of a disappointment. Actually, that's sort of a proxy for emerging markets in general. If I have one area of macro concern since we last met a year ago, it's that quite frankly one of the great planks of that big drive upward, as we all know, were emerging markets, the BRICS. That is now an area of great concern as it should. You just pick up the paper and you know that it's no longer the BRICS, it's now KE. China is sort of the last BRIC standing. The worst thing I heard the other day, I was reading, I think the Financial Times, some bankers said, Brazil is now Argentina, Argentina is now Venezuela, and Venezuela is now Zimbabwe. We've had this sort of massive shift down in terms of expectations. That's a bit of a concern. Now, traffic, boy, we've moved into a, shall we say, almost surprisingly stable environment. Haven't gotten December's yet, so we don't have 2013s, but you can see we're running in a 5% zone, which isn't bad. It's not a bad place to be. Cargo in November showed a sudden either signs of life or dead cat bounce, depending upon your perspective. But cargo has sort of been in a grim position for some time now, and there's an interesting story there that relates to the sort of strong numbers we've seen on the commercial jetliner front. Get to that in a bit. Now, a quick couple of charts that you've seen already, but I'd like to reinforce it because it is still my acting thesis as to what the hell just happened. It's not this chart. Oil prices superficially do have a relationship with jetliner output. I mean, we can all see that, but hey, one is an economic variable, the other is a market that grows over time. Don't read anything into this. Similarly, you might be inclined to see an inverse relationship between the cost of capital and jetliner demand. But again, one is an economic variable, the other is a market that grows over time. This chart is a false friend, as they say. You should not see anything. What you should see is this, which is that for the first time in many decades, there was, how to put this, a massive rip in the fabric of the universe. Massive divergence between the cost of cash and the cost of fuel. And historically, you go back a few decades, and it was a simple, I'm not quite sure about the economic rationale for this, but they kind of moved in tandem. And so if you were an airline, and oil was expensive, and you wanted to refleet, you couldn't because, well, interest rates were really high too. And when interest rates were cheap, well, hey, oil was $22 a barrel, and those fully depreciated DC-9s made an awful lot of sense. So why not keep them flying? It made perfect sense. For the first time in many decades as a mature market, we had a huge incentive for airlines to refleet. And what was the cost of cash? 0.1, bring your wheelbarrow to a local central bank. Now, accompanying this was the complete collapse of all other investment opportunities for this cash. You're a bank, you're a financial institution, they are encouraging you to take money, you don't know what the hell to do with it. I mean, it's not earning you anything, but you put it in real estate. Yeah, that wasn't a great idea. Tech stocks, The Onion at the time had a terrific headline, satirical paper, of course, a terrific headline, "Nation looks around desperately for hope of new bubble." You know, I mean, so where do you put this cash, the 0.1%? Well, you know, our humble industry, we are a great home for assets. I mean, we are a fantastic mobile asset that is going to be earning people money somewhere. And you look at the history of jetliner finance leasing,